When planning for a single client who has no children, it's really easy to approach estate planning with tax neutrality and not consider the effect of the estate tax or the generation skipping transfer tax. In other words, these situations are often considered simple, but there's actually many tax complications to consider, which may actually make this type of client have a more complicated situation than you'd find within a married couple with children. There are some tidbits we're going to look at today. One, transfers to devisees in the same generation may lead to deaths shortly after, which may also lead to multiple unnecessary layers of estate tax, especially for business assets if there's not the right type of planning. You can use the estate tax charitable deduction to zero out the estate tax, but if the exclusion amount goes down, this may unnecessarily limit the amount that goes to devisees of the single individual. And without children or descendants, GST tax planning is often ignored, but it should still be taken into account. So, for example, if there's any lapse or remainder gifts going to a skip person, those do not generate GST tax. Then finally, lifetime gifting should be considered, but may have enhanced options under current and proposed laws for single individuals. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode 199, we're going to dive into just some tidbits on estate tax planning for single individuals. By no means is this an all-inclusive list. These are really kind of some high-level things I see planners not necessarily missing, but not always addressing in their conversations, especially because when an individual doesn't have close family members, they're often not as concerned about the estate tax, but it's still something where you need to at least be able to check the box and say that you've discussed it so that people don't come after you for the payment of unnecessary tax. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you'd like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to our presentation. For a single individual, some things to keep in mind are first, they have two exclusions that you should be concerned with. One is the $11.7 million estate tax exclusion, which also covers lifetime gifts. The other one is the $11.7 million generation skipping transfer tax exemption. And both of those are on the chopping block right now. They shouldn't be wasted because they could go down to $3.5 million. So that's an $8.2 million swing that's lost in two layers of tax, the estate tax and the generation skipping transfer tax. Now, without children or descendants, you may not be concerned with the generation skipping transfer tax, but you can still use that GST exemption where there's an indirect skip with GST potential. So there's still an option to plan for that within the estate plan itself. Now, when somebody is single, assuming no common law marriage issues pop up or anything like that, there's no marital deduction too. So you can still zero out the estate tax with charitable deductions, but that's going to peg the amount going to non-charitable beneficiaries to whatever the remaining exemption is. So that may not always be a good outcome either. We'll look at that. And then finally, when there's no planning within a family unit, especially, your chances of successive deaths increase when you have devisees in the same generation. So, for example, if you had somebody who died and left something to a sibling or business partner and that individual died within 2 years, then look, there could be multiple bites at the apple for the estate tax, especially if the exclusion amount goes down, and especially if there's not the right planning. So, estate planning should take into account that type of potential that could happen. So, starting with GST use, since you have no children or descendants, oftentimes you're looking to leave assets to non-skip persons as your devisees within the estate plan. Now, that could waste some GST tax exemption, and that may be avoidable. We're looking for good and not perfect here. Now, unless those gifts lapse to skip persons, then you could have some GST exemption use. But what you may want to consider is looking at, okay, If you intend to have gifts that don't lapse, which maybe would go to the descendants of a devisee if that devisee predeceases you, it may make more sense in that case to instead leave it in maybe a sprinkle spray type of trust, which includes skip person beneficiaries as current income or remainder beneficiaries. By doing so, you create GST potential, and it allows you to assign your GST exemption to that asset and not lose it. Not only that, you can assign your estate tax exemption to that as well, which would reduce that risk that we're going to look at in a minute of successive estate taxes. Now, that type of approach really makes the most sense for appreciating assets. So if you have wasting assets, it's still a good idea to look at those as being good candidates for direct specific bequests, things like vehicles, even a lot of tangible personal property that's not a collectible or jewelry or artwork or anything like that. Now, next we have the charitable deduction. With the lack of a marital deduction, it makes it harder to zero out an estate if you don't have a spouse, and it makes it harder to defer that estate tax until a successive death. Now, you have to give assets to charity in the case of a single individual in order to zero out the estate tax. But that may not be part of the single individual's actual plan or intent. So, in other words, if you zero out the estate with the charitable deduction, right now it allows you to give away $11.7 million to friends and family. But if the exclusion goes down to $3.5 million, well, guess what? Friends and family aren't getting much. And that's only after taking into account lifetime gifts. So lifetime gifts could reduce that amount even more. So instead of the traditional zeroing out formula, which gives everything over the exclusion amount to charity, which is kind of the default that a lot of planners go to, it may be better to consider some other approaches. One is maybe consider a set dollar amount, maybe a minimum or maximum you might want to go to non-charitable beneficiaries, which would require some payment of estate tax, but it may be a drop in the bucket in the grand scheme of things to make sure that your charitable and non-charitable intents are carried out. So you could consider an intentional payment of estate tax as well, but maybe also look at capping the estate tax at a certain amount so that you can take into account the liquidity needs of your estate, of the devisees and heirs who you want to provide for. You also might want to consider lifetime gifts, and we'll look at that a little bit later as well. Next, a big issue is successive transfers. And I don't think a lot of planners really think about this, but if you have single individuals leaving assets to somebody in the same generation, especially high value assets like business interests, that could create unnecessary estate tax. So for example, we have a business that's owned 50-50 by your client and the client's business partner. Then the client leaves a 50% interest in the business to their partner directly, paying some estate tax on that. And that could also be the case in a buy-sell agreement as well. But what happens here is business partner now owns 100% of the business in his or her own name, and at death now has to pay estate tax on the entire amount. There's no marital deduction or anything like that to defer estate tax or do anything like that with. So what happens there, if you have those two rapid estate taxes, especially if the exclusion goes down between client's death and business partner's death, what can we do? Well, for one, there is a prior transfer credit which may relieve this somewhat, but isn't necessarily perfect because it keeps going down in 2-year increments. So what might work better is to consider maybe leaving the 50% interest at first death to a credit shelter trust, which could be exempt from estate tax at the death of the business partner, so that that risk of double bites at the apple is reduced. Then finally, lifetime gifts obviously make sense, especially if there's potential devisees. The thing you lose here is that, single individuals tend to look at friends and associates, and those relationships can be more transient. So this can be a hard sell because it's difficult to consider making a permanent gift to somebody whose relationship with you could shift on a dime within a 3-year period because you don't have that blood relationship. So beyond that technical and relational issue, if you're just looking at estate tax, the applicable credit as proposed is really going to be based on the greater of the following amounts based on regulations that have come out in the last year or two. One, it's going to be the greater of the exclusion amount that's available at death, which is now 11.7 but could go down to 3.5 million, or the exclusion amount, if greater, will be equal to the amount actually used for lifetime gifts. So if you use up that 11.7 million or even any amount over 3.5 million now, then you get a greater applicable credit against estate tax. So with that being said, for widows anyway, it's a good idea to look at whether there's been any deceased spousal unused exclusion that's been preserved through a portability election, because that would make a good potential tax-free gifting transfer. You want to use up that unused exclusion preferably during life if your assets are sufficient to do so. Now, beyond that, we looked at the relational issue. Another one is giver's regret. So the individual who's single may give away assets just out of a tax planning concern, but may need access to those assets, especially when there's no family to bail them out post-gift. Now, one thing that's been floated out there is the use of a grantor retained income trust, or a GRIT, and that type of arrangement changed with the Chapter 14 gifting rules in the mid-90s and is no longer available to leverage a retained interest for gift tax purposes. But you still have the same issue of estate tax inclusion beyond a term or at death if you retain that interest for your lifetime. And a lot of practitioners have talked about how a GRIT type of arrangement may be abusive, but it's important to note that the Chapter 14 rules do address and allow a GRIT in the case where an individual has no children or descendants. So because of that, if you were to create, say, a lifetime GRIT, you may be able to leverage a retained interest and use up some estate tax exemption right now. And with that, there's a possibility that it may not be abusive because that type of arrangement has specifically been blessed in a situation where an individual making donor has no children or descendants. So that's one thing to think about too, if access after the gift is going to be a concern. So lots of tidbits there. Like I said, this isn't an all-inclusive list, but hopefully that gives you a taste of the fact that estate tax planning for single individuals is a little more complicated than it might look at first glance, and there should be more intentional conversations around that for those who might have taxable estates under current law and under legislative changes that have been proposed. Now, as always, if you have non-client related questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.